Hi everyone. So as you may have seen from my most recent post on the Patreon, I've been spending the best part of 3 weeks researching for new businesses or stocks. But the one I've spent the most time analysing by quite a long way is Farfetch. Ticker symbol is FTCH. They're best known for their luxury goods marketplace that's growing rapidly, 40% year over year to put a number on it at the moment. But they go beyond just being a traditional e-commerce marketplace or retailer. That's what really makes it interesting to me. Farfetch is a technology company through and through, and they just happen to serve one of the most underpenetrated areas of e-commerce, which is personal luxury goods. And so I thought it would be good to do a video for you all explaining why I'm looking to potentially start a position in Farfetch very soon. We'll get to why I haven't yet towards the end of this video, but hopefully it's also going to shed some light on my research process, how I dive into a company, see if it qualifies as one I would want to invest in. And it's going to be hard to fit all of the necessary information into one video, but I'm going to do my best. So why don't we start off by establishing what sort of qualities we need to see in a business in order for it to qualify as a potential investment. And as you know, we're aiming to own long-term compounders. So ideally, we want to see these 4 attributes. 1, a clear competitive advantage or advantages that are improving over time. And this is how moats are created. As we're looking for, early stage compounders, not ones that are near maturity, the compounding may slow down. We're looking for early stage compounders that have the potential to speed up that compounding over the next sort of 5 to 10 years. So if you're looking for a clear and obvious moat, you're probably not going to find it. But what you need to see are clear competitive advantages. So next is good unit economics, and that leads to high potential returns on invested capital over time, which is really essential for companies to compound their earnings at a high rate over time. Next is good management and capital allocation. So we need to know that we're in good hands, that we trust the CEO of this business, and that he's going to be able to run it in a way in which we'd run it ourselves if we were in charge. And then lastly, a long and visible runway for growth, allowing plenty of opportunities to reinvest shareholder capital at high rates of return. That's essentially how the compounding starts to take place. So if we can tick all these boxes that we've just looked at, i.e. establish that we have a potential compounder, then we can start to look at price and focus on valuation. But for what it's worth, I always do a quick sense check of the valuation to see if I'm wasting my time or not. We don't want to be looking at something that's growing at 20% and it's selling for around 80 to 70 times earnings. That, in my opinion, looks like a waste of time up front. So for Farfetch, they're actually selling at 5.5 times next 12 months, i.e. Q2 2022, so this time next year, their revenue, which is reasonable for a marketplace business that's growing at a 40% clip. 5.5 times is relatively cheap when you look at some comparable technology companies. So now that's covered, let's look at the business. As a brief overview, Farfetch is a luxury goods marketplace, technology platform, and brand incubator. They primarily operate a third-party marketplace for brands such as Gucci, Prada, Versace, among hundreds of others as well. So this also allows those brands to sell direct to over 3 million active consumers on Farfetch's marketplace, replacing the traditional wholesale route, which offers lower margins to the brands and less control over pricing and distribution, things like that. So that's the third-party marketplace. Additionally to this, since they acquired NGG, which is New Guards Group, in 2019 for around 600 million, Farfetch now also operates a first-party area of the marketplace for some of the fastest-growing luxury brands in the world, those being Off-White and Palm Angels, to name a couple. And the most underappreciated part of Farfetch's business, for me, is their white label platform solution, which is called FPS, stands for Farfetch Platform Solutions. Essentially, FPS simplified is a tailored luxury e-commerce offering that creates global websites, apps, or even WeChat stores. So yes, Tencent actually owns a stake in Farfetch, which is another interesting part of the business. And on the back end, which is essentially its value proposition, FPS synchronizes retailers and brands' websites with their in-store and warehouse inventory in real time, and also connects to any other suppliers in their distribution network. And other functions, to name a few, are in-store pickup, returns handling, marketing in-house, and warehousing, things like that. So it's a really sophisticated offering, for a lot of companies, being the brands and retailers who are traditionally brick and mortar companies, not necessarily tech savvy. So it really adds value there. And some early adopters of FPS are Harrods, which is a company that does 3 billion in retail sales annually. And then we've got Chanel, which does over 10 billion in revenue annually, and one of the biggest, and most respected luxury brands in the world. So according to Farfetch, there are actually 20 brands and retailers in total who are powered by Farfetch Platform Solutions, with many more potential customers in advanced talks. So that's the overview of the business. Now, let's run our checklist. And remember, we're not fishing for a yes or giving a weak reason as to why this company fits criteria or has these attributes. If it doesn't, it doesn't. It's as simple as that. We're trying to think crystal clear and with rationality. So first of all is clear competitive advantage that's going to improve over time, or advantages. And they do have a few. We'll start with what the advantages are on the brand side, which is first of all, low cost distribution method. They're the lowest cost available at the moment for brands to go direct to consumer, apart from using their own e-commerce offering, of course. So it's a 30% take rate on GMV versus the traditional 50% for the traditional wholesale retail route. And then also, remember, this is an 80% margin industry in terms of what it costs these brands to make their goods. So it costs them 20 pence, let's say, to produce these products. They sell them for £1. So it's 80% margin. And with the 30% take rate that Farfetch, get from this, essentially brands are making a 50% margin by using Farfetch. All of the operations are outsourced. That's from cost of customer acquisition, i.e. marketing, to transaction, to fulfillment, to customer service. It's all outsourced and handled by Farfetch. So there's a lot of value added there for the brands. Second is global reach. So they have over 3 million customers spending over $600 to $700 per order. And that's not available through most competitors, if any. And additionally to that, they get access to China through WeChat and Tmall through their links with Tencent and Alibaba. Now, what about advantages to the customer? Essentially, this is what is going to be the most important thing if we're talking about a marketplace platform. The customers are driving traffic onto the platform, and that's what essentially creates more sales for everyone involved. So one advantage I would say is because of their marketplace model and global supply network, they don't hold any inventory. They have more selection than any other platform in luxury. Farfetch think this is roughly 5 to 6 times the nearest competitor, which is obviously a huge amount larger than their biggest competitor, and they can deliver to more countries than any other competitor as well, which is a big value-added prop. Now, second is the fact that they're just quicker, easier, and more reliable to use. This is because mainly the logistics and fulfillment network that they have. Farfetch deliver most items on the same or next day, but also can deliver products from Western Europe to China in 3 to 4 days. And I don't think anyone else can do that in the luxury industry at the moment. And then putting all that together in almost every past case study for marketplace platforms, the winner has traditionally been the player with the lowest cost, highest selection, and highest convenience. And I'd say for now, Farfetch seems to fit that bracket. And so next is attractive unit economics. Like I said in my post on Farfetch, the income statement does look ugly, but when you look closer and see what most of their cost has, and see that most of their cost has been, demand generation and marketing, things like that, and technology development, capitalized technology development, in other words, growth initiatives. And then plus you look at the progress they've been making year over year in terms of getting the maintenance costs, so the fixed cost structure, down as a percentage of revenue, you start to see the full picture. After all, it's predominantly a marketplace platform, a technology platform. So in most cases, they don't purchase or hold any inventory or require much working capital at all. Therefore, it doesn't take much to figure out that with scale, the unit economics of this business are very good. As an example, we can look at their mature cohorts, right? Customers acquired around a year ago or more, and these cohorts currently have a 55% contribution margin to Farfetch. And for new cohorts, Farfetch said the average payback time for acquiring a customer is just 6 months on average because of the average spend being so high. That's an incredible payback time. So all of this suggests there is really attractive unit economics once this company starts to scale or reach a level of maturity. And so because of this, Farfetch has a target. The CFO has set a target of 30% EBITDA margins at some point in the future, which they believe they are well on track for. They're set to be profitable this year, not really for trying or prioritizing profitability, but just generally because their platform is scaling. And then when we think about free cash flow, which is obviously going to be our main metric here, because of the low capex requirements and low working capital requirements, of this business, EBITDA should translate nicely into free cash flow. If the CFO and CEO are right in their estimations that this business can reach 30% EBITDA in the future. So all of this suggests obviously high returns on capital, high potential returns on capital, and I'd estimate them to be north of 25%. Now, the next thing is good management and capital allocation. Are we in good hands? And I'd say we most definitely are. We've got a founder-led business here, right? The CEO, Jose Neves, created the company back in 2008, and really he's got connections, all over the fashion industry with some of the most powerful families controlling the world's most valuable fashion brand. So he's very well connected. He's passionate about luxury fashion and technology. He's a tech guy with a passion for fashion, which is definitely what we want to see in this company here. His track record in terms of capital allocation and investment speaks for itself. Even recently, acquiring NGG for 600 million in 2019, that's already been value accretive. I think the earnings yield on that investment has already got up to around 10%. We've got Stadium Goods for 200 million back in 2018, I think that was, and again, that's been very value accretive. So, if we're judging him off of his past investments and capital allocation, not even just talking about small investments, we're talking about buying up groups, buying up companies here. He's done it in a very intelligent way and managed to add value to those brands and to Farfetch simultaneously. Now, additionally to this, we see him making the right decisions today for the company. He's investing today in initiatives like FPS, like the China platform that will benefit the company far into the future, despite there's probably, near-term, you listen to the calls, there's no doubt there is near-term pressures from Wall Street analysts. When are you going to be profitable? What margin are you going to be in next year, et cetera, et cetera, et cetera. They've put that to one side and they're focused on developing the value proposition of the platform, which is what is most important for us long-term investors. And a few examples of this are augmented retail initiatives that they've launched with Chanel and some other companies, the luxury new retail initiative with Alibaba, Richemont, and Kering, and then Farfetch China Holdings, which is obviously a new joint venture with Alibaba. And so all in all, this is a very creative founder, intelligent founder, good operator who's a step ahead of his industry, it seems, with great track record of value accretive capital allocation as well, which is good to see. And then another positive is he owns a 15% stake in the entire company. So he's very well aligned with what we want as shareholders, which is long-term growth. Now, the next and probably the most fun part is long runway for growth. Does it have a visible runway for growth? We've established it's a business that has the tools necessary to compound. Does it have the addressable market to do so? And I'd say it absolutely does. We've got the TAM for luxury goods is around $350 billion as of today. Bain, an independent research company, estimate it should reach $400 billion by 2025. And I'd say even $500 billion by 2030 if we're looking at past compound annual growth rates. So the luxury goods market, as a whole, to give you an overview, has grown at around a 6% CAGR over the past 25 years. So that's double or triple that of the global economy. And I personally expect online penetration to speed this CAGR up in the near term. So what does that mean? That means this is a company, Farfetch, that's not only eating into market share, but it's going to have that tailwind of TAM growth behind it as well, maybe 6 to 7% annually, which is really exciting. So on top of that big TAM, we've also got the fact that online sales as a percentage of the TAM is growing at a 25% clip year over year. It was only 20% in 2020, but that's expected to normalize just shy of that in the next year or so. Bain Research, again, they expect this penetration rate to reach over 30% by 2025, creating a pure online $120 billion opportunity just in the digital side of the business in the next 3 to 4 years. Now, additionally to this, maybe the biggest growth opportunity for luxury goods is in China, and this applies to Farfetch as well. China as a segment is growing at 45% year over year. And here we're talking about a market in China, where consumers' preferences are to shop online. China has the highest e-commerce penetration rate out of any major country. So it's a huge opportunity for Farfetch, and they've already established themselves as a front runner to win market share. Not only, do Tencent own a sizable stake in Farfetch and they operate on the WeChat platform with all of its customers, but Farfetch recently announced a partnership with Alibaba, who, in all honesty, are the person you want to partner with in China if you're going into luxury or retail. So This partnership was with Alibaba and Richemont, as well as Artemis, who are the holding company for Kering, the second largest luxury brand company in the world. All three of these companies now own a stake in Farfetch, and then Richemont and Alibaba get a 12.5% stake in Farfetch China. So it's a pretty exciting joint venture. This partnership will give Farfetch access to 800 million Chinese consumers on Alibaba's Tmall platform. And although the deal was announced at the end of 2020, the Farfetch store on Tmall isn't actually going live until the end of this year. So Farfetch expects results to start being visible in 2022, which is very exciting. It's a big catalyst, I think, for the company. So in respect of runway for growth and opportunities to reinvest, it's there. It's there in plenty as well. They've got a huge market opportunity, and Farfetch are making all the right moves in order to capture market share and be a leading platform in the luxury goods market. And so in summary, let's tick off the list. We've got number one, clear competitive advantages that are improving over time. Yes, I believe they do have a few that should develop, into a moat with time. Not just yet, but should develop. Second, good unit economics leading to high potential returns on capital. Yes, it does. Third, good management and capital allocation. Yeah, I believe we are in good hands. And then fourth, long and visible runway for growth, allowing opportunities to reinvest. It most certainly does, as we've just covered. Now, this isn't to say there isn't forces preventing Farfetch reaching this intended destination of being the number one luxury platform in the world. There most certainly is forces that will affect them, and they have competition from online retail brands, omni-channel wholesalers, as well as brands' own direct e-commerce offerings, although they're nowhere near the sophistication of Farfetch yet, but that is still a threat and a possibility. And there's also the possibility that myself and very other research experts like Bain are wrong about the adoption of online, and maybe the online penetration doesn't grow to 30% and beyond from the 15 to 20% mark where it is today. So there is assumptions here to consider, and there are some risks involved. But we do have the makings of a long-term compounder, I'd at least say. And the likely destination for Farfetch in 5 to 10 years seems like a very favourable one. So now for the valuation. Let's tie up all of the narrative and research that we've just done together and come up with a reasonable estimation of the future. If I give you a quick glance, I haven't gone with my traditional DCF or DCF valuation method here, because it isn't a company we can reasonably estimate the current and future cash flows with. There probably isn't going to be a huge amount of cash flows for the next sort of 2 to 3 years, at least I'd hope. I want them to reinvest all of that money that they're earning. So instead, we're going to look at the key business drivers, or what I believe to be the key drivers that will create financial value in the business over time. And then we'll see what sort of destination for the business that gives us, and we'll discount that back at a desired rate of return to measure how well priced the stock is today. So if we just run through the model here, the first things I want to look at are these KPIs. So it's active customers, and then the average customer spend, which is average order volume times the number of orders. So you can see at the moment, in the middle of 2021, we've got around 3.3 or 3.4 million consumers on the platform, and then the average customer spend is around $939. So, what I think is reasonable is we've gone with 25% growth year over year in terms of active customers. They're currently adding, like 700 to a million each year onto the platform. So currently active customers growing at above 50%. I think 25% is more reasonable for a 5-year outlook. And then the average, customer spend, I think is going to grow at a steady 7.5% over time as people start to migrate most of their spending online, like we've seen in a lot of other industries. And 7.5% is a fairly slow growth rate if we look at how quickly it's grown in years prior. Now, the next thing we want to look at is this contribution margin. This is what's going to drive that 30% EBITDA margin. Ideally, we want to get them back up to 50 or 55% as a contribution margin, where they are at the moment with their mature cohorts. So, they've shown us they can get there when they're not reinvesting to get new customers onto the platform. But it's just a matter of, if they're going to be ready to do that in 2025. But I've put it in there as 50%. I think if they can get a 50 to 55% contribution margin, we'll start to see that 30 to 25% EBITDA margin. And all of that gets us to a GMV for the digital platform of 11.7 billion. And in context, that's around the same size as Nordstrom are at the moment, and they're mainly in the US. What we have to add to this is the brand platform. So the brands that they own, I have that growing at around 10% year over year. It's currently growing at around 10 to 15%. I think it will continue to grow. They have some young and fast-growing brands in there. So I've put it in as 10%. That brand platform GMV is fully earned. So that gets us to a gap revenue here. We'll put the adjusted revenue in and then the fulfillment revenue, which is just around 12% of adjusted revenue. That gets us to a gap reported revenue of around 7 billion in 2025 for Farfetch, up from around 2 billion today. So we're expecting some fast growth. And then at the bottom here, we've got our EBITDA calculation. So essentially, if they make a 20% margin, a 25% margin, or a 30% margin, these are the EBITDA numbers that we're going to be looking at. So 1.2 scaling up to 1.8 billion. Now, if you ask me, if they hit any of those numbers, whether it be 20% or 30%, I think we'd do very well from the price today as an investment. That would still be a very good result for us investors. This here is at 25 times EBITDA. What would the company be selling for in 2025 reasonably? And I think they will be selling for anywhere between 31 billion and 47 billion as an enterprise value. The market cap's probably going to be a little bit higher than that because of the cash they may have or cash they've produced on the balance sheet. But we'll go anywhere from 31 to 48 billion as a market cap. And just doing some quick math on that, if the market cap today is 14.5 billion, in most cases or in every case here, we've got more than a double in 5 years, which is our hurdle rate. We want the value of our investment to double in 5 years because that's a 15% compound annual growth rate. Here are the exact present values of those estimations. And remember, this isn't accounted for any cash flows we may receive over the period, which is likely we do. So these are conservative present values, but they range from 14 billion, which is close to the market cap today, up to around 21 billion on a 15% cost of capital or opportunity cost of capital or discount rate, however you want to put it. So according to my little model and to my underwriting sheet that I've got here, this is a stock that is very much undervalued. Now, add to this the fact that the analyst consensus price, not that it means a huge amount, analysts can always be wrong, but they've got it as $56 as their consensus estimate versus $41 where it is today. So it's a big delta, most definitely. And looking at all of this, it's great. We look like we have an undervalued stock on our hands in terms of what it can do in the future with quite reasonable assumptions, 25% and 7.5% combined growth in those drivers, getting us to around a 30% CAGR over the next 5 years. That seems reasonable. Management are going for 30 to 35%. So, all of that's great. We've looked at the characteristics of the business and it looks good as well. Why have I not invested? And the answer is, although I've done a lot of work and may seem convinced, I'm still cautious to pull the trigger. And why is that? Well, I like to research more than one or two companies at a time. And this way, you frequently fall victim to the need to act. And when you find a good business, you always feel like you need to act like I do here. So I think researching 3 to 5 businesses at once, crossing over through a structured process, of course, so you're not just bouncing around and not really getting much information. And you also have to tell yourself, really, you can only invest in one. So just choose the best one. And this is a great way to think more deeply about what you're buying and dig deeper into the investment thesis and the threats to that thesis. It also makes you spend a lot more time on the research process than you probably would if you were just researching that company. So I'm currently researching some others as well as Farfetch, and I still want to decide on investing in just one name. In the long run, if we're talking about a 5-year holding period, missing out on buying the stock at $41, even if it goes up to $44 or $45, it isn't going to matter much if the thesis that we have here, this thesis plays out. That's going to be it for this video, guys. Just wanted to jump on here, talk in a bit more detail about my research that I've done on Farfetch, why I'm looking to potentially open a position in the next couple of weeks, and then hopefully it sheds some light into my research process, what I'm looking for in an investment to qualify as a long-term compounder. But as I mentioned, I will also be doing some analysis on some other companies as well, and then deciding on which one I'm going to add to my portfolio. So I'll let you know once I've done all of those. I'll maybe put a video up or just put a post on the Patreon, but make sure you keep an eye out for that. I'm going to add this to our DCF valuation sheet, even though it's not a DCF, it is still a valuation model as such. So I'll add that to there if you want to have a play around with it. Let me know in the comments below what you think of Farfetch, and I'll see you all in the next one.